All right, Boz here, and today we are going to take you through financial forecasting using Microsoft Excel. When I think about the learning objectives and the agenda for this one, we're going to prepare a forecast in Microsoft Excel. We're going to utilize key input cells. We're going to leverage from income statement and balance sheet forecasts as well. Now, the overview of it, we're going to talk about uses and purposes of forecasts. Then we're going to get into the income statement, then the balance sheet. Then cash flows, looking at those from an accounting standpoint, the statement of cash flows, the finance standpoint, and free cash flows, and then the complexity of working capital. It's all just going to kind of work together. And how this is going to go is, after the income statement, we are going to do some Excel work. After the balance sheet, we are going to do some Excel work. And after the cash flow section, we are going to do some more Excel work. So I'm going to be bouncing back and forth a little bit between the PowerPoint and the Excel template file. So if you want to have that open, definitely do so. So the uses and purposes, when I think of purposes of forecasting, owners or managers of a business, they're going to be trying to estimate profits, cash flows, and debt needs. So if it's a public company, more on the profit side and the cash side. If it's a private company, really focusing on cash flows, and then if they need to get out in front of any borrowings. Shareholders and financial planners are going to look at potential forecasts of a company, or maybe do their own forecast to analyze value when making buy or sell decisions. Lenders, they're going to look at a forecast prepared by management, or maybe prepare one of their own to try to figure out if the company could repay debt and how risky it is. And that might determine the amount that would be lent, if any, the interest rate that would be charged. Investment bankers are going to be determining the value for mergers and acquisition types of activity, initial public offerings as well. Auditors would use forecasting to test assets for impairment. Tax advisors, I spent my professional career in international tax and finance, and we did a lot of restructurings and refinancings where we needed to know value of an organization in order to implement a tax planning strategy. So I ended up doing a lot of this work in my career as well, pre-academic. And then analysts, discounted cash flow models for valuations. There's gonna be a little valuation work at near the end of this video, but that would be the subject of a separate lesson. I'm going to show you how we could take a forecast and turn it into a valuation, but that valuations is not the core objective here. It's just putting together a forecast that would be used for any of the purposes here that you see on this slide. Useful information. So if management has forecasts, those are certainly going to be great to see. Internal documents, management plans, management projections. If you can get your hands on those, certainly if you're within the company, you'll have them. But if you're external, you might not be able to access those. If you're external to the company, you could see press releases. You could see SEC filings like 10Qs, 10Ks. Go on a company's website, see earnings call transcripts as well. Analyst forecasts can be tougher to obtain. Yahoo Finance does have some summarized information that you could find. Historical information, optimally you'd start with the last 3 to 5 years of information. And that's just going to give you kind of a benchmark to consider when putting together a forecast. It's not as good as looking forward. But for an example, if a company has been growing revenues by 1% a year for the last 5 years, and it's suddenly forecast to grow them by 30%, it's like, okay, what has changed to make that realistic? And then if you're in the middle of a year, certainly looking at the most recent quarter's results can be useful, just to try to get a better forecast for where the year will end up. So a quick review question on this one. Which of the following would not be useful in preparing a forecast? Well, and again, the key is not. Analyst information, that's incorrect. Those can be very useful if you can get your hands on them. Historical information, it can give you some insights. Management forecast, that might be the absolute best if you can get your hands on it, because assuming that it isn't too rosy or too aggressive, Management is the group that really knows better than anyone where the company is headed. So yeah, all of the above would be useful in preparing a forecast. Well, let's jump on right now and we'll go through a few slides related to the income statement, and then we will do some Excel work in forecasting an income statement. So jumping into some details here, we're going to start with sales. Now, sales is the starting point for all forecasts. Oftentimes it's an indicator of if the company's growing or if it's getting smaller, and that will dictate how a lot of the other items get forecast as well. There's probably nothing that is no metric that is used more often in a forecast for different line items than sales. Jump off point for a lot of things. We want to use any available management or analyst information that we can get. If we have information about backlog and how that compares to prior years, orders and how they compare to prior years, that would be useful. And then seeing how that backlog or order in prior years turned into sales that year, and then using some trends in the current year. Looking at historical information, but be careful of acquisitions, dispositions, because that can certainly, if you had an acquisition in one year, it could impact how your sales grew in that year differently than in a future year. Changes in levels of capital expenditures. If a company is investing more in capital expenditures, building more facilities or something like that, they probably expect to expand sales. Also, economic conditions. One of those could be COVID. As far as looking backwards, we're going to be looking back 3 to 5 years of financial statements for companies still. So at some point in time, I won't say COVID, but a lot of companies had unusual financial statements for 2020 and then still 2021. Most companies were normalized in 2022. But for the next couple of years, if we're still gathering historical information, we're going to want to be mindful of how an organization might have been impacted by COVID, which was more unique to that time and might not continue. In the long run, a company might hope to grow sales a little better than inflation, so maybe about 3%. Maybe it's they want to be gaining a little bit of market share, growing by a couple percent per year per gaining market share, and then a couple percent per year for inflation as well. So again, that would be more long run for a company. In the short run, most companies are going to be a little bit able to fine tune that prediction a little bit more. Now, expenses like cost of goods sold and selling general administrative expenses, usually we're going to forecast those as a percentage of sales. And we're going to consider management guidance, but also look at a lot of historical trends. Again, we're going to show you an Excel file where we're going to do all this. If there was one-time items, restructurings, or impairments or something like that in a prior year, we would certainly want to exclude those going forward if they weren't expected to repeat. Now, in an optimal situation, these would decrease a bit each year, assuming that the company is growing sales, which most companies we hope that they are doing, right? And this would be because a company is going to be trying to control cost, as well as it has some fixed expenses that would be then spread over a larger amount of sales. So in theory, growing company, COGS and SG&A should go down, not in dollars, but as a percentage of sales. Now, when you're looking at historical percentages, look for trends and look to continue them. Keeping in mind that some trends cannot last forever, might need to be slowed down. So if a company has really been getting efficient in the last 3 years and decreasing their cost of goods sold as a percentage of sales, it's not like they could keep that going forever and eventually have zero cost of goods sold, right? Absent trends in the past, we could consider an average for these items. And we're going to look at this kind of stuff, exclude one-year blips when we're doing trends or averages, and then certainly put more emphasis on recent years. Sometimes we do ignore historical information altogether if the current information we have and future information is better. Okay, moving on here, depreciation and amortization expense. We deduct depreciation in our forecasts, again, from an income statement and not capital expenditures. And then we want to consider, some things related to cost of goods sold and SG&A But level of acquisitions. So if we've acquired a lot of PP&E, if we've made some acquisitions which have given us intangible assets, we are going to expect depreciation and amortization expense to increase. A note about depreciation and amortization here. Financial statement forecasts are pretty easy. The short answer is especially for depreciation, you don't need to worry if book depreciation is also deductible for tax in whichever year. There are some rules that tax depreciation is deducted more quickly. You don't have to worry about that in a financial statement forecast. It's a concept that depreciation is a timing item for tax purposes, so it doesn't impact total income tax expense. But for cash flow forecasts, you do need to technically begin with tax deductible depreciation or amortization and computing something that we call NOPAT. And then we will add back tax depreciation and amortization and deduct capital expenditures. And that's because if we have more tax deductible depreciation than we do book depreciation, that would reduce our income tax bill. So moving on to interest expense here. Interest expense is generally going to be a percentage of interest-bearing debt. In recent years, for investment-grade companies, it would have been in the 3 to 4% range. When I say in recent years, if I was going back over the last 10 to 20 years, with inflation that we have seen in 2022 and 2023, and it's slowed down here in 2024, oftentimes those companies have borrowing rates at 5% or higher. So a little bit higher interest rates right now. They had been in that 3 to 4% range historically. Investment grade companies are generally considered the safer companies. That would be the subject of a different course. Income tax expense. That's going to be forecasted as a percentage not of sales, but of pre-tax income. The U.S. corporate tax rate is about 21%. Average state rate is about 4%. So oftentimes, if you don't have any better information, you might just assume an income tax rate of about 25%. Now, companies can lower their rate through international operations, research and development credits, some other credits out there. Yeah, look to competitors, look to management guidance, look to historical rates to try to figure out what would be proper. And if there's some one-time items, maybe there was a big tax settlement with the IRS, as an example, that just impacted taxes one year, then you would want to ignore that. But then also the political impact. When I was doing forecasts coming up, through the 2020 election and then into 2021 and 2022, I think everyone expected that corporate taxes were going to go up under the Biden administration, probably to the rate of 25 to 28%. They didn't, but a lot of people in conservative forecasts, conservative meaning to show more expenses, might have just put that in as a placeholder, just to say, okay, in a bad case scenario, bad case just from a low income and low cash standpoint, what if the tax rates are higher? I'm recording this one in August of 2024. So certainly as we get closer to the election and then whoever wins the election this fall, we could end up seeing some signs about movements in tax rates. So plan accordingly with that one. Other income statement items, interest income, historically it's been so small that we could almost ignore it or it just wouldn't have much impact. But in recent years, it's been more in that 2 to 5% range. A lot of times companies have invested in short-term treasury bills, as an example, or money market accounts, certificates of deposit, yielding sometimes closer to 5%. So just being aware that more recently, those rates have been higher. Historically, they were probably 0.5% or less. Non-controlling interest is really going to be beyond the scope of where we're trying to get here today. This is a portion of a joint venture that is not owned by the company, and absent better information, just use historical trends. If there's one-time items, gains, losses, or discontinued operations, we generally are going to assume that they don't repeat, so we're not going to estimate them into the future. Inflationary impact. We're just kind of coming out of a period of high inflation. From 2000 to 2020, it was at 2%. And then after COVID, it jumped up to 4.7%. In 2022, it was 8%. Started to come down in 2023, getting pretty close to historical averages in 2024, and then right back down to close to that 2% starting in 2025. So as you're thinking about forecasts and what percent inflation to build into some of your assumptions, I'm going forward now, so I'm probably using that 2.5%. Historically, like in 2022, what forecasts had to do was maybe have a two-part forecast. How much do we think we're going to increase volumes, like units sold, and how much do we think that we're going to increase prices due to inflation? Well, review question here. As a company's sales increase, how would we expect expenses to change? So take a peek at this one. Sales increase. How are expenses going to change? Well, they're not going to increase as a percentage of sales because fixed costs will be spread over more sales. They're not going to stay the same because fixed costs are going to be spread over more sales, causing expenses as a percentage of sales not to stay the same. That should actually say decrease right there. It would not stay the same in dollars. All right. It would likely increase in dollars due to an increase in variable costs. So the correct answer here, decrease as a percentage of sales, that's correct. Fixed cost would be spread over more sales, causing expenses as a percentage of sales to decrease. So again, this word right here should say decrease. I'll fix that on the hard copy slide. So moving on here, review question 3, income statement forecasts. What do they deduct? Both depreciation and capital expenditures, just capital expenditures, just depreciation, or neither depreciation nor capital expenditures. Well, it's incorrect. They don't deduct them both. Only depreciation is going to be deducted. So not both, not capital expenditures, not neither, but depreciation is going to be deducted in an income statement forecast. If this was a cash flows forecast, then it would be only capital expenditures. Review question 4, income tax expense. How is it forecasted? As a percentage of cash, pre-tax income, net income, or sales? Well, it's not cash. That's interest income. It's not net income. It's done on pre-tax income instead. It's not sales. That would be the most common mistake I would see people would make, is that, and in theory, if a company is increasing its sales, it probably will, hopefully increase its income tax expense. Hopefully it's making more profits, right? But it's just that we have a much more refined thing. We can actually forecast pre-tax income, and that is going to be the best metric on which to gauge income tax expense. Well, we're going to move on to the balance sheet in a minute, but first, not a minute. It's actually probably going to be 20 minutes or something like that. We are going to start hammering through an income statement forecast. So what I have here, this is an actual these are actual results. This is not a real company. I just made it up, but it's saying that we have actual results for 2020, 21, 22, and we want to forecast for the years 23 through 27. And we're just going to do it using the techniques that we've talked about and historical information. Certainly, if we had analyst information, if we had management information, that could take precedent over some of our assumptions. But here's the income statement. Here are your assets. Here are your liabilities and equity accounts. And then there's a couple more specific cash flow items as well, capital expenditures and dividends. And if we go down a little bit, what you can see that I did here, and this would be very common that you would see in valuations, is I have created percentages for my base year columns, my actual year columns. So this 8.7%, you can see that formula. That is current year revenues minus prior year revenues, and then that difference all over prior year revenues. The same thing in 2022. Current minus prior divided by prior. So what that means is that we had revenues that were going up by 8.7%, 8.8%. So absent any better information, we're just going to assume that revenues are going to grow by 9% in our 5 forecast years. That's way too simple, right, for a real valuation, but we're just trying to get the mechanics down here. So we could just assume that. Now, cost of goods sold, excluding depreciation, we can see, and what this formula is doing, B5 divided by B4, if I hit an F2 on it and go up above, I can see that B5 is COGS, B4 is revenues, and so what that is, we've got 57%, 56.5%, 56%, all right? And those are going to decrease by 0.5%. We see them going down by 0.5% per year in the prior years. It's just kind of like the company's growing its sales and it's getting more efficient. So for simplicity, let's also show that decrease where the COGS are are going down by 0.5% a year. You can see that I actually I hard keyed in a minus 0.5% right here. And then this formula takes that prior year 56% and adjusts it downward by that 0.5%. And why I did that is because that's a key assumption, right? So I could change this to 0 if I want, and that would now show no efficiencies in COGS. And key assumptions you just want to highlight because that's something you would work together with others doing the forecast to try to say, okay, is this the best that we can do with this one? Gross margin, we're not going to forecast that one. We're going to compute it. SG&A, you can see that over the 2 years, it went from 30 to 29, so maybe it's getting 0.5% more efficient per year. So I did the same concept as I did with cost of goods sold, going down by 0.5% per year. I just assumed that 31% was a blip. Now, again, we'd want to dig into that and actually figure out, what was going on behind that one to see if it was truly a blip or not. EBITDA is going to be just a simple computation up above. Depreciation, we can see it's going up each year. So I am also going to show that going up by about 0.7% each year. It looks like the company is just spending more in capital expenditures. Depreciation is therefore going up. Similarly, I just kind of did this by hard keying an amount right here and then putting this formula in so that if someone came in after the fact and thought that was too aggressive and said it should only be 0.2%, we could pop it in and it would adjust all of our formulas. What I've actually, done in these is I did like for cost of goods sold equals the prior year plus this change, and then I hit F4 before I left that cell. So when I copy this over one cell here, now it's going off that previous cell, but because I hit F4, it put the anchor or the lockdown on this G43. So when I copy these over, it's always looking to the cell to the left and then reducing it by 0.5%. Interest income, in prior years, it had always been 1%, so let's just go ahead and hold it steady at 1%. It's, I've shared in the slides that maybe interest rates have gone up. So we'd want to just look and talk to the bank and figure out what's going on, right? Interest expense, this company historically maybe borrowed at 6%, so let's assume that that's going to stay the same. Income tax expense, it looks like if I actually go up to the income statement here, they had a lot of income tax expense in 2020. And then, 0.9 as compared to 1.2. Maybe these are in millions, so that's like 0.9 million compared to 1.2 million of profit before taxes. Where in the next 2 years, that's a lot smaller. So what this might mean, maybe there was a big IRS settlement that year. We had an IRS audit and we had to make a big payment, something like that. So we're going to just assume that that's a 1 year blip and then go more toward the 25% average that's been there in that past 2 years. And we also know that average to be the federal and state tax rate. And that's the income statement. All right. And we're going to do the balance sheet in a bit right here, but those are the income statement forecasts. So now the formula, if you want to actually just do this on your own, equals prior year revenues. So equals D4 multiplied by 1 plus, and then I will go down to this 9% cell right here and then hit close parentheses. So what this is doing is it's taking the prior year revenues and growing it by the 9% increase in revenues that we're forecasting. Okay. And then if I want to paste this to the right, I can highlight this range right here. I could hit a Control C or a Control V to copy. My favorite way to copy is just a Control R. It's a copy, paste. I highlight, again, this range, and I hit Control R, and it pastes that formula to the right. So every year it is growing sales by 9%. Now, why I highlighted it here as a key input cell, let's say that revenues, we just said they're not going to grow at all. Maybe not realistic, but I'm just trying to show an illustration. If I hit enter there, and these cells are all linked to that, they don't have to be, but I chose to, now sales would not be shown as increasing. So that's kind of how we're using the forecast. Cost of goods sold excluding depreciation. In this formula, what I want to go down to is cell E5 right here equals, now I don't want to do the prior year. I see that mistake sometimes. Equals revenues multiplied by, and then I'm going to go down to this cost of goods sold excluding depreciation of 55.5%. All right, so it's taking revenues by the percentage that I forecasted. Remember back to the PowerPoint slides, we forecasted based on a percentage. And now I can highlight this range right here and do a Control R. So what it's doing is it's taking this declining cost of goods sold percentage and multiplying it by an increase in revenues. That's what's going on right there. Gross margin, I'll do equals revenues minus cost of goods sold. I will then highlight this range right here and hit Control R. SG&A expenses equals, go ahead to revenues multiplied by, and I'll go down to my SG&A expenses. I'll hit enter right here, highlight this range, and then hit Control R. Okay, so I'm now, this is taking revenues multiplied by SG&A that I forecasted each year. My EBITDA. Now, there's certain things that we can, try to do to, and I'll just show you one right now. Okay, so I'll back up a sec. But another way that we could have done this is equals revenues, and then before I leave that cell, hit F4, not once, but twice. It's going to lock down the 4, but not the column E, and then do multiplied by. Go down to my SG&A percentage. Okay, so you're like, okay, I don't know what you just did there, Boz, why that's different. The main thing that I did equals the E4 and then hit F4, not just once, because that'll lock down both the E and the 4, but twice. It'll only lock down the 4, multiplied by, go to my SG&A percentage right here. And now I'll paste this off to the right. And the reason that I did that is because with this entire range highlighted, I can hit Control C and then go to depreciation and hit either Control V or enter. And if you look what it's done now in this cell, it's still going off E4 and it's still moving to F4, G4, H4, I4. Had I not locked down the 4 when I pasted this formula down, it would have got off of row 4 and got into row 6 as an example. So it's still taking that sales, but it's multiplying it by the new line, the line 47 that I'm looking at. Now, that's just a way of trying to work a little smart in Excel. And I wanted to show it to you because gross margin is, E4 minus E5. So it's 2 cells above minus 1 cell above. When I go to EBITDA, that's also going to be 2 cells above minus 1 cell above. So what I'm saying here is I could just hit gross margin or highlight this right here. Hit a Control C on top of that. Now go right here and hit Control V. 2 cells above minus 1 cell above. Go to EBIT. It's also going to be 2 cells above minus 1 cell above, so I can just hit Control V again. So again, in gross margin, I highlighted these. I hit Control C, go down to EBITDA, hit Control V, go down to EBIT, hit Control V. All right, so it's just trying to work smart in Excel. Certainly, I probably spent more time explaining that to you than if I had just done it from the onset. But it's a little trick, and when you really when you get good at these tricks, it'll enable you to go the fastest as possible. And you want to get these are just hardcore financial modeling skills right here that you want to get fast at. Interest income. This is going to be equals. Don't go to interest income, but it's actually going to be equals cash multiplied by the interest rate of 1%. Okay, so I did right here E17, which is cash, times E49, which is the interest rate on interest income. And then I can go ahead and paste all this off to the right. Right now it's blank because cash is not forecasted. And we're not going to forecast cash until we get to the balance sheet. I'll address that in, I tell you what I wanted to do. Let's just, for right now, we're going to delete this because this is not right. But I just want to, in cell E17, just link to cell D17. Highlight these cells and hit Control R. I just want to show that the cash forecast, or the interest income forecast, is working. So again, equals, go to the cell to the left, highlight this range, hit Control R. And that's just to show it's working. We'll fix that. Similar to interest expense is going to be equals long-term debt multiplied, and then we can go down to the interest expense forecast of 6%. So this right here, it's equals the debt, which is not forecast yet, multiplied by the interest expense of 6%. I can copy this over by highlighting this and hitting Control R. And then similarly, just so we can see that it's working, let's link to that long-term debt and copy that over with a Control R. So again, what I just did equals, went to the previous cells. Well, I'm on this cell. I highlighted the 4 cells to my right with a shift and a right arrow key, and then hit Control R, just so it looks like it's forecasting. That one we actually will keep the same, but we haven't got to the balance sheet yet. Profit before taxes equals EBIT plus interest income minus interest expense. I'll hit enter on that one. And again, it's EBIT plus interest income minus interest expense. Sometimes these items could be listed as negatives, and then you would just have to be careful with that formula to do this properly. Here, I just have everything listed as a positive. Companies are not always consistent with their financials. They do them right, they compute them right, but they're not consistent in positives versus negatives for expenses and such. And then with this range highlighted, I'll hit Control R. Income tax expense equals profit before taxes multiplied by, I can go ahead down to my income tax forecast of 25%. So it's equals E13 times E52. And I'll hit enter. I'll go ahead then and paste over with a Control R. And then from a net income perspective, equals profit before taxes minus income tax expense, and I will paste that over with a Control R. So once again, 2 cells above minus 1 cell above. I mean, you could have gone up here to like where it says EBIT and just grabbed this, hit Control C, and then went down here and did Control V, because again, it's 2 cells above minus 1 cell above, just if you're trying to work smart in Excel. But this is an income statement forecast now. And I always just say look at it for reasonableness. It looks like sales are growing, sales revenues, and then it also looks like net income is steadily growing, right? So that would tell you if you'd somehow linked to the wrong line in there somewhere, and you could get a forecast that wasn't making any sense. So we're going to go back to the PowerPoint now and talk about how to forecast the balance sheet, and then we will forecast the balance sheet. So first, looking at cash. Cash is very frequently going to be a plug account to make assets equal to liabilities plus equity. If it's going to become negative, then we might use short-term debt as a plug account. That would almost be like a line of credit. And then plug accounts, we need them because we don't forecast using a debit and credit approach. You saw what we just did for the income statement there. We just used kind of our best estimates. So our forecast is not going to be balanced unless we have a plug account. So we're going to do that with cash. Now, this is one of the most critical areas to forecast is going to be cash. So oftentimes we will run a sensitivity analysis based on key metrics like sales growth, like cost efficiencies, to see how they're going to impact cash. Some of the other items right here, receivables, inventories, and other current and long-term assets, looking at historical trends, also just factoring in management guidance. If it looks like we're going to try to, collect receivables quicker or maybe stockpile more inventory so we don't have stockouts, something to that effect, which could impact those. Looking at average days receivables and days inventory for an industry, I say absent any other information, just start with 30 days receivable and 60 days inventory. Those are some half decent estimates. Companies will oftentimes give customers 30 days to pay, and it might take them on average 60 days in order to sell their inventory. Now, that's like if you have no idea where to start and you haven't even evaluated the industry, because these can definitely be very, very different by industry. The one note on that as well is that sometimes companies in a more sophisticated forecast will actually, and so I will usually do these as a percentage of sales in a simple forecast. In a more advanced forecast, you maybe would forecast days receivables, days inventory, and then use that forecast to build in, what your forecast for receivables or inventory are going to be. But for simple, do it as a percentage of sales following trends or what you're hearing from management going forward. Fixed assets. All right, I break those into two different things, gross fixed assets and then accumulated depreciation. Gross fixed assets, we're generally going to increase it based on what we're forecasting for capital expenditures. Accumulated depreciation, we're going to increase that. And when I say increase, it's a negative. So the negative is getting larger for current year depreciation expense. And gross minus accumulated depreciation is going to give you net fixed assets. You could, and the simple thing for net fixed assets is it's just prior year plus capital expenditures less current year depreciation expense. You could, in theory, forecast something like net fixed assets as a percentage of sales and probably come fairly close. But I think just because it's easy to carve off capital expenditures, depreciation expense, and because you're also going to use those in cash flow forecasts, I prefer, as well as analysts will prefer, to forecast fixed assets and accumulated depreciation differently. I think I bumped that. Yeah, and generally don't assume significant disposals unless the company is in regular habit of disposing of assets. Most aren't. Intangible assets and goodwill, this is a really tough area because if you look at a company's financial statements, these amounts are probably changing. But it's tough to forecast acquisitions, and acquisitions happen at all different prices. So it's just really tough to forecast. So I generally, in the first step of the forecast, don't assume that there's any increase in intangibles or goodwill. And about the only thing that I would do is I would reduce intangibles by basically amortization expense. The next part, when we are looking at the liabilities, we have short-term debt. As discussed above in the cash section, this can be a plug account if needed. Otherwise, we'll oftentimes just hold it constant. Current liabilities use historical trends as a percentage of sales. More sophisticated forecasts would use a days payable approach. Long-term debt, similar, to how we use, we don't forecast an increase in goodwill or intangible assets. I usually don't start with forecasting an increase in long-term debt unless the drafts of the forecast imply that we are going to need to borrow in order to basically sustain. And then taxes and dividends payable. So If tax estimates are changing due to changes in tax rates, or dividends are changing due to dividend policy, then you would need to modify those accounts to account for that change. Stockholders' equity, common stock, and additional paid-in capital, it may increase by a small amount each year due to stock compensation. We oftentimes can find evidence of this in a cash flow statement. That's usually not very material. We generally will not assume any sort of big offering or anything like that. Treasury stock, this is one of the more complex ones if a company is doing share buybacks to actually forecast, and that's because it does not follow a consistent trend like almost every other account does to some extent. This can be all over the board. So we can look for trends on the cash flow statement. We can look for management guidance on this one as well. Retained earnings, we're going to use the prior year and then add in net income and subtract out dividends. We don't want to do this as a percentage of sales. Oftentimes, we can see a trend in dividends per share and then forecast a dollar amount for that based on how many shares are outstanding. Accumulated comprehensive income. This often relates to foreign exchange, and that can be difficult to predict. So we generally will start by holding this one constant unless this is a really significant amount and you're in a jurisdiction where you can actually do you're in a jurisdiction where inflation is a lot different than the U.S., then you would maybe use some sophisticated techniques, international finance techniques to compute that. Non-controlling interest, similar to the income statement side of things, just use historical trends. Review question number 5. Accounts receivable are generally forecasted as a percentage of what? Well, it's not cash. Only interest income is based on cash. It's not debt. Only interest expense is based on that. It's not net income. All right, that's just a computation. It is generally going to be sales, and as a percentage of sales, that those are going to be forecasted, unless a company is going to separately forecast days receivables, as an example. Review question number 6. Plug accounts in financial statement forecasts are going to cause kind of a certain type of error in Microsoft Excel. This is one that I had not covered in the so far in the PowerPoint, but that's all right. We'll just talk about it right now. You will see that when we start using plug accounts, it's not going to create something called absolute, rectangular, or triangular references, but we are going to see something called a circular reference. And I will talk about that once we get into the balance sheet. And then this review question, which would be the most common plug account used in a financial statement forecast? We don't plug common stock. We will increase it if there's evidence that will happen, oftentimes through stock-based compensation. It's not net fixed assets. We forecast that by looking at capital expenditures and depreciation. It's not revenue. We forecast that with trends. It would be cash. We don't per se forecast cash. We plug cash to make the balance sheet equal. The next section we will get into, is cash flows. But before we get there, let's go back to our forecasting template and work on the balance sheet. So if we're looking at this one here, we do have our balance sheet for the past 3 years. We could go down and we could look at some of our assumptions. So in this situation, cash, we're not going to forecast that because that's going to be plugged. Accounts receivable, these are a percentage of sales. So they were just slightly increasing. So similar to what I did with some of the expenses is I just said, okay, they're going to go up by 0.2% per year. So I took the previous cell and added 0.2%. Inventory is a percentage of sales. It looks like it was increasing, so we said, okay, let's increase that by 0.5% per year. Other current assets slightly going down, so I said, okay, let's continue that downward trend. You would never go below 0 in something like this. So if it looks like it was a downward trend, you would stop at 0. PP&E is going to be separate forecasts. We don't forecast total assets. That's a computation. Accounts payable had been steady the last 2 years, so we're just going to keep them steady now. You can see I still used this input cell, but just kept it in there at 0%. Other current liabilities going up slightly, so we're going to increase that by 0.1% each year. And then the other items we don't forecast, we are going to compute those. Capital expenditures, we can see that those are increasing each year, so we are going to grow those by just a forecast here of 0.6%. Again, just trying to do a reasonable estimate with respect to those items. So now if I go back up to the balance sheet, so cash, I'm a little afraid I'm going to forget to remove cash. So I'm going to delete that right now, okay? And that certainly got rid of the interest income right here. So what I want to do is do equals, and I'm in accounts receivable, go up to revenues, and then I'm going to hit F4 twice. Just like I did earlier, it's not going to lock down the column, but it is going to lock down the row, multiplied by, and then I am going to go down to my forecast for accounts receivable. Normally I'd use a little page down, so I go click on this forecast and hit enter. So I've got, my sales are increasing, got my accounts receivable forecast in here. Similar to what we did above, I'm going to highlight these cells with a shift and a right arrow key and then hit Control R because it pastes those to the right. And now what I'm going to do, and this is going to make it efficient, all this is highlighted, I'm going to hit Control C, which is a copy, and I'm going to paste it wherever else we are going to be forecasting things based on sales. So inventory, is going to be based on sales. So I'm going to hit Control V right here. Other current assets, I'm going to hit Control V right there. They're done based on sales. PP&E's not, nor total assets. Accounts payable, let's hit Control V. Other current liabilities, let's hit Control V. Those items are not going to be done that way. And capital expenditures, that already was done. That formula, I had already built that one in there. So now we have a lot of the balance sheet forecast is already done because it's based on sales. Well, property, plant, and equipment, let's just start working down. I'm going to do cash last, so equals the previous cell plus capital expenditures. All right, and then I want to subtract off depreciation expense, and I get that from the income statement. All right, so I've got previous year plus capital expenditures and then subtract off depreciation expense. It's important to kind of look at those signs as far as are they being shown as a plus or a minus. Sometimes capital expenditures on the cash flow statement, they're usually going to be shown as a minus. So if you were, pulling stuff from a cash flow statement and you saw that they were, a minus, you would have wanted to then in this formula right here actually added those in by subtracting off a negative cell. But right here, I just put them in as a positive. So we're increasing by capital expenditures, decreasing by depreciation. I'll copy this one to the right. Okay, total assets, Alt equals to sum those up, but I don't just want to cut off right here. I need cash in there. Okay, so I'm going to then hit enter to lock that one in. And what that is, if you have not used Alt equals before, that is a sum feature. And then when you do that, it just sums up the items that cell is kind of touching, but we are going to include cash in that ultimate formula. So I want to then just highlight the 5 items, the 5 rows that are going to be in there. Alt equals, and then to extend that up, I just hit an arrow key, and I'm just holding down shift as I'm moving my arrow key around. If we'd actually had something for cash in here, like 1 or something like that, and I hit Alt equals right here, then it would sum it up. So Alt equals, then move the formula so it adds that all up. Paste it off to the right. All right, total liabilities, Alt equals, and then highlight these cells and do a Control R. Common equity, we're not forecasting any issuances here or anything like that, so I can just link to the previous cell and then paste that over with a Control R. All right. Long-term debt, I didn't address that, but I just held that constant because it has been constant. And we're assuming they're not doing any more borrowings. Retained earnings. This one is more complex. Equals previous cell plus go up to net income and then subtract off. And I'm going to find it right here in cell E37, dividends. All right, so equals previous cell, prior year retained earnings, plus net income, minus, go to dividends and hit enter, and then highlight these cells and do a Control R. Similar to what I said up above with capital expenditures, if dividends are shown as negative on this sheet, you would need to actually then, like your formula would have to say plus that negative number. But at the end of the day, you want to make sure your dividends are reducing retained earnings. Total stockholder equity, I'll add this up with an alt equals, highlight these cells, and hit Control R. And then liabilities plus equity equals liabilities plus stockholders' equity. And then highlight these cells with a Control R. So just add it up, liabilities and equity. And what you'll notice is this does not equal total assets, and that's because we don't forecast in a debit credit framework. We don't have cash done yet. Cash is a plug. Now, what we need to do with this plug account for cash equals right here, and you might need to rewind this formula, but equals liabilities plus equity minus, and I want to subtract off my other assets. So go to accounts receivable, go to inventory, do a minus and go to other current assets, do a minus and go to PP&E. So we are seeing right here that now we've got 15.2 of cash, 65.3 of assets, and that's the same as liabilities and equity. So you need to do an equals, go to liabilities and equity, and don't subtract off total assets because cash is in that amount. So that just wouldn't work. I think if you did it, it comes out it comes out kind of screwy. Okay, so equals liabilities and equity, and then subtract off these other four assets, all of your other assets. Sometimes if there was enough here, I could just type in sum and then open parentheses and then highlight the four, not the total, but the four individuals that I wanted to subtract off. Or just equals total liabilities plus equity minus receivables, minus inventory, minus other current assets, minus PP&E. And then paste this one to the right. Now, one thing to note is that you do see calculate on right now. If you go to file and then down to more and then into options, you are going to see a formulas little tab here, and we want it to be automatic, and you do want to check enable iterative calculation. So I want it to look like this. What that is going to do is going to allow a circular reference. If this doesn't say automatic, that probably does on yours, it probably doesn't say manual, but if this box is not checked, I can just uncheck it once. You can see that it's got circular references, and often, I don't know, depending upon when you did it, it might even just kind of zero those amounts out. It says you got circular references there, but I want to go to file, more, options, formulas, enable iterative, okay, because what's happening here is that when we put in this amount for cash, it actually increased interest income when we insert an amount for cash here. When we increase interest income, that increases net income. That increases retained earnings, which increases equity, which increases liabilities and equity, which therefore means that the plug to cash has to be bigger, which then increases interest income, which increases net income, retained earnings, equity, total liabilities plus equity. It goes circularly. So by putting on that enable iterative calc, it allows for those circular references to work. And it says it'll go up to 100 times. It'll just kind of keep running through that circle until the amounts get so small and they're negligible, and it just kind of stops, for lack of a better term. It stops in that circle. It's a little bit confusing, but that's what you need. If you don't do it, your balance sheet won't balance. It won't necessarily work right. And we are done. And if I take a little look at this one, your total assets are going up each year. I'm just kind of spot checking this. Your total cash is dipping a little bit, and we're going to go to the cash flow statement and try to figure out why the cash is going down. It's probably due to capital expenditures. We can see total liabilities are going up by slight amounts. We've got total stockholders' equity is going up by slight amounts as well. So I'm just kind of checking that for reasonableness. And what's beautiful about this is the way that this all works together. Like if I wanted to change, and let's just go ahead and look at our cash of $14.9 million in that final year right there. If I do something like change revenues, and let's just go to a huge number, like 25%, that is now going to flow all the way through my forecasts, and it'll jack up these revenues a lot higher, and it will ultimately flow all the way through net income and into equity and into the balance sheet that way. So, it looks like cash went down probably because we have a lot of cash, things that are cash outflows that are based on revenues. But I'll go back here and do the 9%. All right, back to the PowerPoint slide and cash flows. Well, cash flow items, there's accounting, where there's net income on the income statement. And then there's also, in order to do that, we're going to start with net income on the income statement when we do the accounting statement of cash flows. Then we add back depreciation and amortization, which we've forecasted on the income statement. And then this is by far the most complex thing. We want to adjust for the change in working capital. And what the phrase here actually says is it says less the increase in non-cash and non-debt net working capital. That is a lot, all right, in that phrase right there. But what it's basically saying is if your increases in things like receivables and inventories are bigger than your increases in things like account payables, that is going to end up causing a decrease on your accounting statement of cash flows. All right, we're going to go through some examples on that. But that will then give us cash flows from operating activities. We subtract out our investing activities, our purchases and sometimes small amount of sales of capital expenditures, and then subtract off financing activities. Maybe you're paying down debt, buying back shares, making dividend payments, or perhaps you have increases due to borrowings, bond issuances, or stock issuances. And that is going to give you your total change in cash. Let me then go to the accounting statement of cash flows. All right, net income equals, I'm in cell E82 here, go up and click on cell E15, net income. Add back depreciation equals, go up to your income statement and click on depreciation. Now change in current assets excluding cash. If current assets go up, this is going to be a decrease on the statement of cash flows. And if current assets go down, it's going to be an increase on the statement of cash flows. So what I do is I do equals, and then I will go up to my current assets, not including cash. So I'll be taking accounts receivable. I'll add to that inventory. I'll add to that other current assets, and I want to subtract off the ending balances. And what's going to happen, and you got to make sure you get this formula right, that current assets are going up, and that's going to cause a decrease in the operating activity section on the statement of cash flows. I've got a section later that's going to go through those examples, but this is the mechanic. So I'm doing prior year minus current, and because the current year is larger, it's going to be a decrease on the statement of cash flows. Now current liabilities equals, and then I will go up to accounts payable, which is a current liability plus other current liabilities. Subtract off previous year. So with current assets, I did current minus prior. With current assets, I did prior minus current. With current liabilities, I'm doing current minus prior. And that's because if current liabilities goes up, we need to show an increase on the statement of cash flows. Again, an example is coming on that. I'll do an alt equals here. Cash flows from operating activities, $6.1 million. Now, capital expenditures, the main thing to do here is don't just do equals and then go click on them right there, all right? Because that's implying that it's positive. So do a minus because I've listed them as positive up above, and then go click on it, all right? If I listed them as a negative number, you could have just linked to it. And then we'll do alt equals. Issuance or repayment of debt, so equals, and I don't think there's any, but we can put it in as a placeholder, equals long-term debt in the current year minus long-term debt in the prior year. So if there was an adjustment, it would go through here. The payment of dividends, we want to do a minus because these are cash outflows. So I'll go ahead and link to cell E37, and then cash flows from financing activities, alt equals. Now you can see my ending cash I've already linked here from the previous year. So to D17. Okay, so what I want to do in this situation, so what I want to do then is with beginning cash linked to previous year's ending cash, you'll see why in a moment. Change in cash equals cash flows from operating activities plus cash flows from investing activities plus cash flows from financing activities, and those pluses are correct. So it'll be it's actually going to be a negative number here because the two negatives were bigger than the positive. And then alt equals, and with any luck, I always do this, and I'm not actually consulting my solution as I go, but I can actually grab. So I'll go right here, cell E82. I'll highlight down to the end. Now I'll go over to the right, and I can hit Control R, and it's going to paste everything all over to the right at once. And with any luck, the ending cash is going to be equal to what it says on the balance sheet. So again, I just did a Control R. I highlighted just the stuff in column E and then pasted over the Control R so I could do it all at once. 14.9 of ending cash. Go up to the balance sheet. Hey, it's a bonus. Once in a while, I mess something up, and then I have to figure out what I did wrong. But I got it this time. So that's how you would do the accounting statement of cash flows. So now then, we'll go back to the PowerPoint deck here. Okay, current slide, pop through there. The finance statement of cash flows. Well, we're going to start with finance. We're trying to come up with free cash flows. So we start with operating income. We reduce it by income taxes, and that will give us net operating profit after tax. If a business has net interest expense, no PAT, that's net operating profit after tax, is generally going to be higher than cash flows from operating activities under the accounting principles. And most businesses, yes, do have interest expense more than interest income. So no PAT is generally higher than cash flows from operating activities. We add back depreciation and amortization. We grab those from the income statement. And then once again, we adjust for the change in non-cash and debt net working capital. I have still a couple slides on that coming. And then subtract out capital expenditures to get to free cash flows. What we are doing is free cash flows, by definition, is just more of your cash from your operations subtracted off by your capital expenditures. So what we need to do here is exclude interest expense. All right. And then we're also not going to put in like financing activities. So that's why we have to take a unique approach to this one. If I go back to, let's see, I'm going to go back to my Excel work, and then we'll go back to the PowerPoint. But to come up with free cash flows here, this is the last section in this Excel sheet. So EBIT is operating income. I'll do equals and then fly up to the income statement. And I did that by doing page up. Okay, so equals and went up to the income statement with a page up. And now taxes. I'm going to show this as a negative. So minus EBIT. And I'm not going to go link to the income tax expense because that has given you a tax deduction for interest expense as well. So we're kind of looking at this as if we didn't have interest expense, free cash flows, financing activities, it excludes debt, it excludes interest expense. We look at those separately. That would be more part of a finance course. And then we multiply that by our tax rate. Okay, so I've got, this is taxes, this 1.0, this does not agree with the income statement of 0.6, all right? And that's because there's a bunch of interest expense right here that we got a deduction for on our basically computing our income statement, but we're assuming for free cash flows that there's no interest expense, all right? Again, finance topic. NOPAT is alt equals. That's a new concept, net operating profit after tax. It excludes interest expense. Add back depreciation. So then equals, I will just go up to the accounting statement of cash flows to that 5.1. So equals the 5.1 right there. Change in working capital. I'm going to talk about this one when I'm done here in a moment. But change in working capital equals, I'm going to then go to my change in current assets plus my change in current liabilities. So what you're seeing right here, E84 plus E85, okay, equals E84 plus E85. And that's the change in working capital. Your capital expenditures equals, go ahead up to the accounting statement of cash flows. And then now my free cash flows, alt equals, but I got to remember I'm starting, I want to sum up this whole range right here. I'm starting with NOPAT, which is a subtotal, and then we're adjusting it by depreciation, working capital, and capital expenditures. Those are my free cash flows. I will then grab this range, I'll highlight it. I did shift and down arrow keys. I'll hit the right arrow key a few times and then hit Control R. Now these are my free cash flows, and that's an important finance metric. Again, a whole different course. This would, managers would then know what they could spend their cash on, different options. This is also used in valuations quite a bit as well. So that concept of free cash flows. Now, the one thing I want to make sure is, if I was back in that PowerPoint slide, it said that NOPAT should be bigger than cash flows from operating activities. So we have 12 million right there, or excuse me. What I'm trying to do is compare NOPAT, 5.2 million, to cash flows from my operating activities of 12 million right there. I said NOPAT should be greater. What that should technically be is that it's NOPAT adjusted by depreciation and the change in working capital. So what I'm actually looking to compare, I can look at my NOPAT, add back depreciation, change in working capital. This is 13.3 million. I want to make sure I'm comparing apples to apples here. That's higher than cash flows from operating activities of 12 million. And basically the difference between this 13.3 million, again, I see my little sum down here. If you don't know how to get those in there, you right click, down in this bar, and it lets you put a lot of little things in there, sum, min, max, items like that. But what it's higher by, this 13.3 million compared to the 12 million, it's 1.3 higher, which is basically your interest expense minus your interest income. So that's like 1.7 million. And then you got to take the taxes at 25% off of that as well, because the taxes impacted income tax expense. That's starting to get a little bit more advanced, but that's how you would double check that. Okay. So it's working right. But then also we've got free cash flows here. Some people will not do the statement of cash flows under accounting principles, and they would just jump right to a forecast of free cash flows. And you certainly could do that, right? So for things like depreciation, change in working capital, CapEx, you would just link up to the income statement and balance sheet instead. The risk is that when you get done, if you make a mistake, and your mistakes are more likely going to be in this change in working capital line, if you make a mistake, you might not know it. So what I like to do is prove out the statement of cash flows, so that it all balances, right? I mean, I know that this balances my ending cash of 14.9 right here. All right. I know that that balances. So I know that that is right. So now if I'm linking to the accounting statement of cash flows, I've got some pretty good confidence that I'm doing it right. I've seen forecasts where people don't do that and they try to do this change in working capital and they get this formula wrong, because if you don't first do this part right here, right? These are kind of messy formulas, but if you didn't do them right here, when you are in this line, you can't just link to something that's not there. This formula will become pretty ugly and it can be tough to track and try to figure out if you're right or not. So that's where I get my cash flows. I make sure everything balances and then I link to the accounting cash flows. So that brings us to the end of that forecast. Just some things I wanted to say on the complexity of working capital. So what the concept of this one is we are going to we're going to subtract the increase in non-cash, non-debt net working capital. That's what I've said before. So why is this? Let's go ahead and break it down. Working capital is current assets minus current liabilities. When current assets increase, cash is subtracted. So that's what that means. Subtract the increase. So if current assets go up, cash is subtracted. If current liabilities increase, cash is then increased when we're doing cash flows. So why is this? Well, accounts receivable, how do they increase? Well, they increase when you sell stuff on account, which is a debit to accounts receivable and a credit to sales. Income goes up because you credit sales, but there's no cash in there. So because we start the statement of cash flows with net income, and because that's gone up, but we didn't get the cash, we now need to show a decrease in the statement of cash flows for that item. Similarly, accounts receivable, when they decrease, what we're saying then is a decrease in a current asset is an increase to cash. Why is that? Well, if they go down, we must be debiting cash and crediting accounts receivable. There's no impact on net income there, but cash went up. So we have to show that as an increase. If we look at inventories, all right, well, if an inventory goes up, by definition, that's inventory is part of working capital. If it goes up, we've told you that's a decrease on the statement of cash flows. Why is that? Well, we're debiting inventory and crediting cash. There's no impact on net income. So the statement of cash flows starts with net income, right? But that wasn't impacted, but cash went down. So that's why when inventory goes up, we need to show a decrease on the statement of cash flows. Now, if inventory went down, that would be an increase on the statement of cash flows. Why is that? Well, when inventory goes down, it's because we debited COGS, credited inventory. There's a reduction in net income, which is the starting point on the statement of cash flows, but there's no impact to cash. So that's why we would have to do that. Prepaid expenses. If they increased, we'd have to show a decrease to cash. Why? Well, because we would have debited prepaid expenses, which are an asset, and credited cash. Income doesn't change with that, but cash went down. So we have to show that adjustment. Now, when prepaid expenses go down, it's because we use them up. All right. We debited the expense. We credited prepaid assets. There's an impact on net income. It decreased, but cash did not. So that's why we'd have to show an increase there. With accounts payable going up, we've said that when current liabilities go up, that's an increase on the statement of cash flows. So when accounts payable go up, we debit an expense and we credit accounts payable. We'll just pretend that they're purchasing some sort of services expense or accounting expense, legal expense, something like that. Okay, that impacts net income. It goes down, but cash didn't change. Okay, so we need to show an increase on the statement of cash flows because it starts with net income, which went down, but we didn't spend cash. But then when accounts payable go down, there is no impact on net income, but cash went down. So we need to show that decrease. We debit AP, credit cash. There's no impact on net income, but cash went down. So we need to show that as a decrease on the statement of cash flows. Review question number 8. Capital expenditures reduce all of the following except what? Which one of these is not going to be reduced by capital expenditures? Well, yeah, it does reduce free cash flows on cash flows for financing activities. It does reduce cash flows from investing activities for accounting. It does reduce a company's cash balance, absolutely, but it doesn't decrease cash flows from operating activities. It decreases cash flows from investing activities. Review question 9. When a company has net interest expense, which would be larger? This is a tough one, but cash flows from operating activities, net income, NOPAT, or cash flows from operating activities and net operating profit after tax would be equal. Kind of as I mentioned earlier, it's not going to be cash flows from operating activities. It's not going to be net income. That's going to be driven down by a lot of items, and it's not going to be the same. Net operating profit after tax is going to be higher because interest expense would not reduce that. Whereas it does reduce cash flows from operating activities because it reduces net income, which is the starting point for cash flows from operating activities. The final review question 10, how will an increase in accounts receivable impact a cash flows forecast? All right, is it going to be, a decrease in operating activities, not impact operating, decrease in financing, increase in operating activities? It is going to impact operating activities, so that's incorrect. It's not going to impact financing activities. It's going to impact operating. It's not going to be an increase in the operating activity section. It is going to be a decrease. Why? Basically, we sold on account, which gave us net income, which is the starting point for the statement of cash flows, but we didn't get cash, so we need to show a decrease. Well, for the last few minutes, I just wanted to go back and then go to the second tab here, and this is for Johnson & Johnson. And what we have here is the last few years of results. It's a little confusing when you look at the years here. They more or less are a calendar year company, but I think they probably use like the Sunday closest to the end of the year, something like that. So that's why it's not always December 31st of 2020, 21, 22, and 23, but that's more or less what's happening. These are more or less the calendar year 2020, 21, 22, and 23. And then what I've already even done is I've gone ahead and I've done this whole forecast, right, for Johnson & Johnson. And what we are going to do is just forecast cash flows. So this is kind of a complexity. So we're going to forecast accounting and finance cash flows, and then do a really quick valuation at the end. All right, so we've got all of our forecast done. All the assumptions are built in here. So let's go to the accounting cash flows at the bottom. You can dig through this if you want. But net income, just go ahead and link up to that. So equals, go ahead to net income. And the purpose of this one is to use a real company that has a lot more accounts and complexity going on, okay? So we've got our net income equals, add back depreciation and amortization. I think I've got that one listed separately. There's just a lot more accounts here. Oops, where do I have that one? Equals. There we got. We've got all of our cash flow amounts right here. Equals depreciation. Now, this is an example where it's just been shown as a negative. So if I'm going to add it back, I want to do a minus. And then go click on depreciation. Change in current assets. All right. Now, this one can be more complex. So what I would recommend doing in this situation, because if you did change in current assets right here, and this is like the working capital side is a big point of this illustration. Change in current assets, current liabilities, there are a lot of them. Like if you actually go up here, to the balance sheet, you've got a lot more accounts right here. These would become kind of more complex formulas in a hurry that way to look at current assets, current liabilities. So what I'm actually going to do when something is more complex, just create subtotals to make your life easier. So let's go to the previous year here. Current and other assets. So I'm going to go to equals, and then I'm going to go up to my balance sheet. Just got this organized a little bit differently. And I don't want to do cash because cash is what we're proving out. But marketable securities plus accounts receivable plus inventories plus PP&E, I don't need to do this total current assets of discontinued operations because they're done. But one thing that I need to do in this situation, I need to do a plus, and then I actually need to click on deferred taxes and other assets. Every single item that is included on the balance sheet that changes has to be accounted for somewhere. All right. All of the other things that we don't have highlighted, we are going to account for those somewhere. We're going to prove out cash. We're going to dig into property, plant, and equipment, intangible assets, goodwill, things like that. But these items we need to account for right here. And then current and other liabilities go up to equals your current liabilities. We need to account for all of these somewhere. So I'm going to go equals. I'm not going to do debt amounts because I'm going to account for those elsewhere. I'm going to do accounts payable, accrued liabilities, accrued rebates, returns and promotions, accrued compensation, plus accrued taxes on income. Sometimes I could have used a summary right here. And then I'm going to go to deferred taxes, and I'm going to go to employee benefit obligations. And I'm going to go to long-term taxes. And I'm going to go to other liabilities as well. But you notice that I did not use debt accounts in there. So right now, these are my current assets and current liabilities. So when I go back up to my statement of cash flows, right here, I can actually just take these and I can paste these over with a Control R. Okay, so it's going to that next column right there. But when I go up to the statement of cash flows, my change in current assets equals prior minus current, E164 minus F164, liabilities equals current minus prior. Okay, if you try to include this all into one line, it could be really, really messy. Otherwise, cash flows from operating activities, I'm going to add those up. I think one of the only things that I wanted to notice there is this says depreciation and amortization. So I need to do minus, depreciation and minus amortization. Okay, I'd only done depreciation first. My capital expenditures equals, go up to my capital expenditures. Cash flows from investing activities, go ahead and sum that up. Now, issuances or pay down of debt equals, and now I'm going up to my liability section. It's meant to be more complex now, right? So equals ending loans minus beginning loans. Add to that ending long-term debt minus beginning long-term debt. I think I have all these items in here. I'll know at the end. So not a lot of issuances or pay downs of debt. Dividends equals, go to my dividends. Cash flows from investing activities, alt equals. And then my ending cash from the beginning year equals, go ahead up to my ending cash. My beginning cash equals, go to my previous year's ending. My change in cash equals operating plus investing plus financing, and then go sum up my cash. So my cash is now at 22,305. Okay, that equals this amount right here. I'm happy. And go ahead and paste this onto the right. Highlight all this. I did that with Shift, down arrow key, and then right arrow keys, Control R. And looks like I just need to widen out my columns a little bit. I can do an Alt HOI. That widens out columns. It's actually, once I had them down, it's an Alt HOI, or I could just double click between some columns as well. Different ways to do it. Double click is what most people would use. I learned the Alt HOI recently. My ending cash, 73,167. Okay. Need to just adjust it. Need to adjust one thing, it looks like. And I'd paused it for a second. And what I liked, this was not at all intentional, but this is why you do it, right? Do I have anything messed up? So, I mean, I should have just took a cursory look and figured out that this change in current assets and liabilities was zero. You know, my ending cash in my statement of cash flows did not equal my balance sheet. So now it's like, oh, yep. And I probably should have just done this to begin with. I need to forecast out, or not forecast out, but do this computation for my current assets and current liabilities so that it would populate in these sections right here. And now my ending cash, 68,577, it agrees right there. This, with the purpose of what I just did, that's a lot more complex of a cash flows forecast than what we used with that simple template on the previous tab. And now that you have this one done, now you can do your free cash flows, your operating profit. You can go up to your operating profit here. Let's see. So they have, for their operating profit, it is going to be gross profit. They don't have a subtotal for it. That's okay. Gross profit minus selling, marketing, and administrative, minus research and development, minus in-process research and development. Okay, so they just don't have an operating profit. I'm trying to just show a messy real-world company and how you might have to change some stuff. Taxes, I'm going to subtract off this amount, and then I'm going to multiply it by and go up to the income statement and find out what we had assumed for our tax rate, 14%, so they get different incentives. NOPAT, alt equals, add back depreciation, and this should say and amortization, so minus, go up, oops, no, I'll just do an equals because I've already done it. Go up to my statement of cash flows for depreciation and amortization. Do that right there. The change in working capital, if you were to try to do this all in one basically cell here for free cash flows, this would be madness, and it would be tough to know if you're right or not, quite frankly. So that's why I like to link all this together. I know that these two cells are right because I've proved out my cash balance. So if I just link to them, now I'm feeling better about that big change in working capital. Capital expenditures equals, go up to my investing activities, free cash flows, alt equals, my NOPAT, all the way down through capital expenditures, and then go ahead and paste this to the right with a Control R. And now I've got my free cash flows for all of those years. And this is just a little bit of a valuation technique on top of this. So why free cash flows are used sometimes are, by external users is to try to come up with a value of the company. So I use that, and I've got some valuation formulas here, and this would be a different course, but to come up with kind of your free cash flows, terminal value, total cash flows, and a full valuation. You can look at some of the formulas here if you want. That's a much more simplistic valuation. I would do it a little bit differently in a valuation course. And that just used a couple assumptions regarding long-term growth rates and long-term discount rate. Yeah, that's what I've got. This was just, let's just see a more complex forecast. Thanks for tuning in today, everyone. Take care.